This is InvestTalk, independent thinking, shared success.
This is Brandon in DC. Looking for your thoughts on Meritage Homes Corp, ticker MTH. Just wondering if this is a decent stock. So I'll look forward to listening on the podcast. Thank you.
All right, looking at Meritage Homes, MTH is the symbol, $5.3 billion market cap, and it builds single-family homes, mainly to first-time and move-up buyers in central, western, and eastern regions of the United States, so kind of all over. About a 2% dividend yield based on current price. Earnings are supposed to fall 12% this year to $9.39 and go to $10.77 next year. Now, if they earn $10 next year and it's a $74 stock, it's about a 7.5 times P multiple, which is typically pretty good. But we'd like to look at more cash flow than just earnings. And cash flow has been kind of all over the place, and it's actually now negative. And if you go back 10 years, it's actually been negative about half the time. So I don't love that. And then when I head over to its profitability, its return on equity right now is 16%. That's pretty good. Now it dipped in 08, 09 into negative territory, but it's kind of hung around 11, and it's called the mid-teens. Okay, in profitability for the past decade or so. But it peaked back in 2022 around 30%, now down to 16. It's definitely headed lower. That worries me a bit. Good balance sheet, not a lot of debt, but it's in a downtrend like a lot of the home builders. Now, generally, I think home builders are going to do fairly well over the next 3 to 5 years, mainly because there's a dearth of homes out there and dearth of housing, whether that's single family detached homes, condos, apartments, etc. There just hasn't been enough building nationwide. And this is in a downtrend. And I think there's opportunities within more the home remodeling space. So we have companies that sell into that. Think of companies that sell paint and cabinets and things like that for remodeling current homes, as well as sell into the new home market. So we like those type of companies. This would be more of a pure play. It's in a downtrend now. I don't get excited about it at this point, but it's not bad. But I think you have better home builders out there. This is kind of middle of the pack of the home builders that are public. So I wouldn't get excited about this. I'd pass on it. I'd look for a better one that has more consistent profitability, better cash flows, etc. So that was Meritage Homes, MTH. Now let's take a live call. Jason from Illinois wants to talk about taking a loss.
Hi, Justin. Thank you for taking my call, and I appreciate everything you do in helping us become better investors.
No problem.
We had a question recently with the market pullback.
Mm-hmm.
I sold a stock that I trade throughout the year, and it flattened out, and I made the mistake of getting back in, and then it took another downturn, and I just completely got out of the stock. My question to you would be, would the first sell be a wash since I'm going to stay out of it now for 30 days, or would the entire loss amount, could I apply that to capital gains next year, or is it just my most recent selling loss?
Yeah, it's the most recent loss. So you don't touch it for 31 days, and then you can take that loss.
Okay. But that would not apply to the entire amount I lost on that stock, then just the most recent sell.
No, it should. It's as long as you don't have any wash sales. You take a loss and then buy it back within 31 days. You can apply that loss to a future gain. Okay, so I'm not sure.
I did do that. I sold it and bought it back within 3 weeks.
Yeah,
and then I sold it again. So I don't know if that first sale's a wash.
I'd have to look at all of these, exactly, buy, sells, all of that to really tell you. Now your broker will tell you that though. I don't know if you know that, but you'll get on your 1099, it'll say whether it was a wash sale or not. So it's not something you have to figure out.
Okay.
Your broker will tell you. Okay. In this forum, it's hard for me to, I have to really, if you want to send me your trades, I can kind of figure that out for you, exactly if there are any wash sales in there. But yeah, don't worry about figuring it out yourself. Your broker will figure it out for you.
Thank you very much.
No problem. Thanks for the call. Let's go talk to Trey in San Francisco looking at MKSI.
Hey, Justin. Thanks for taking the call.
Of course. Do you own this or looking to buy it?
MKSI. Yeah, no, I own it, and I'm down about 30%. It's now at like the 1-year low, and I'm wondering if this is like a double down opportunity or it's just dead money.
Well, for everyone else out there, MKSI is in the semiconductor equipment business. So it manufactures and supplies instruments and components used to control and analyze gases in the semiconductor production process. So this is a name that earned a lot of money in 2021, $11.36. Earnings went down to $4.42 in 2023, then bounced back to $6.60 last year. So it's earned $7.06 this year. But those earnings estimates are expected to continue lower, and that's why the stock is broken lower. And one of the big issues here is the debt. $5.3 billion market cap, but they have about $4.5 billion in long-term debt on their balance sheet. So leverage is really what is killing them. And their free cash flow, while it has improved recently, it's still down from its high in 2021 of over $500 million. And it looks to have weakened, especially over the last couple of quarters. Not in a major way, but the trend is certainly lower. And I think that's a big issue here. So while it's definitely oversold, it's in a downtrend. It's likely headed back to the mid 60s. That's the lows. Those are the lows from a couple of years ago, 2023 and 2022. Okay, so you're going to see some sort of triple bottom. Whether that triple bottom holds is another question. Now, that's the area, if you're going to double down, that's where you'd want to double down. And if it breaks that, then you're out. You've already taken a lot of pain. I just think it's still very risky. The semiconductor industry was doing well. Now it's certainly slowing in a big way. And you're seeing that with the sell-off across the space. So, I just think, I think of capital, the opportunity cost. What can I do with this money? And a lot of people want to just get back to even. And frankly, I don't think this is worth holding on to. I think there's better opportunities out there in the market. So I would personally just sell it and move on.
Great. Thank you so much.
No problem. Thanks for the call. Now, I hope you've been telling your friends and family that you can find us over on YouTube in video form. And we had questions submitted via our YouTube channel as well in the comment section. So let's go answer one of those questions. Mystery Man says, I keep viewing that tech sector has been downside. However, I've been following up with Dell, and I wonder if this is a good chance to pick it up, or we expect to see more downside in that area. All right, looking at Dell, a name that most people know what they do, right? Make computers, and their business boomed, especially during the pandemic. And the stock went from the mid 30s in early 2023 all the way to a high of 180. And now we're down to 91 and change. Now, this is support. This is pretty good support, actually, right at this level. So from a trade perspective, it's actually a very good spot. If it breaks, call it $87, $86 with any gusto, you're out. Okay. So less than 10% out from here. And it certainly could bounce back. Now, Dell, it's a good company. It's still very profitable. There's obviously a lot of demand for servers due to AI. But that demand, once again, is waning just a bit. At least that growth in demand is waning just a bit. You're seeing that with earnings estimates for this year and next year coming down slightly. But so it's earned $10.51 next year on a $91 stock. Nine times earnings for a company that has let me see. Does it have a good balance sheet? Pretty good. $19 billion in net debt on $63 billion market cap. Free cash flow of about $1.8 billion. That's not bad. So I think from a risk reward standpoint, this is a good spot. Now, is it guaranteed to hold? No. Obviously, we're in a more volatile market. If demand for PCs takes a significant leg lower, this will certainly probably break those levels. But once again, from a risk reward standpoint, I actually like this level. But no, You need to have that out kind of around that $86, $87 level. Thanks for the call, or thanks for the question. And let's go tackle another one of those questions, but this one via iTunes. And we always put these usually as fast as possible on the show. So if you want to get a question quickly, head over to iTunes and leave us a review and put your question in there. And ADL141 says, can you look at ticker LOVE, LOVE? This is Lovesac, LOVE, small name, $255 million market cap. Certainly considered a micro cap. Okay. And let me look at the debt levels. Always these small names, they don't have as easy access to capital as some of the larger names. So they typically don't. If they have a lot of debt, that's a big issue. But this one doesn't. It has zero long-term debt. Actually, there's a bunch of cash on its balance sheet. And free cash flow right now is $28 million on an enterprise value of $193 million. So you're talking about a 15% free cash flow yield. I like that. Earnings are expected to fall, though. That's the big issue here, from $1.45 last year to only 45 cents this year. Now, it is approaching some support down here from the lows back in, when was that? 2023? No, 2020. There we go. Around, $15. Yeah, it's pretty much at support. So this is one of those other good risk versus rewards. If it breaks $14 with any gusto, I'd be out on it. But pretty good risk versus reward right here.
Hey, Justin and Luke. This is Marlo in New York. Love the show. Keep up the great work. You help us a lot. I have a question on Shutterstock. I know a company that you guys have talked about and liked in the past. I own it. And Getty announced an acquisition to buy Shutterstock. And the price that they have committed to is almost $29 a share. Since that announcement, the stock has dropped from 32 down to 20. At the same time, they've released earnings. It seems like a solid company. It pays a good yield. Of course, I know the deal could not go through, but it was a solid business beforehand. So is this a good arbitrage opportunity to buy now? The stock's currently at like $20. And then obviously if it closes, that's significant upside. And then if it doesn't, again, it's a strong business in an area that could see growth. I know there's competition as well with AI and all those things, but I think a risk worth taking. I'm guessing other listeners might be thinking the same thing, since this is a company I know you've liked in the past. Thanks, guys. I'll listen on the podcast. Have a great day.
All right. Looking at Shutterfly. Okay. So this, I'd have to look at the deal. Let me see here. Let me get the information here. I haven't looked at this in a while. This was back in, what was the date on this buyout? January 7th. Okay. And they're merging. Okay. And both stocks went up, but I would imagine here that this deal, here we go, deal terms. Shutterfly investors receive $28.85 per share in cash for each share they own. However, Shutterfly stock can receive Getty stock, or a combination of cash and stock. It looks to me that's interesting. If it's all cash, that makes sense. That doesn't make sense that this is dropping so much, because it should be, you should be getting that $28 per share. So it does. Now, I will say that on the face of it, it looks like, I'd rather buy it. You get my $28 and that's what I elect for. Getty Images stock has come down dramatically. So that's kind of an issue. If this is an all stock deal, I could understand why that was the case. But it looks to be the option of cash. Now, because it's gone down, tells me that's likely to fall through. That's what this is telling me. Getty stock is down, that they maybe thought they had lined up the financing, but they didn't. And so this would be a big bet that they can actually line up the financing. Now, I'd have to dig into this a little bit more. I haven't looked at this one in particular, But that's the signal here that the market is telling me. So I probably wouldn't buy it. Let's see. Yeah, Getty Images just did a refinancing of a $1 billion loan. Yeah, I just would pass on it. That's your bet here that this is going to actually go through, but this is a clear signal that it won't. And it doesn't shock me because both are very small, and in times like this, it can be much harder to get these type of deals through. Thanks for the question. Now let's keep things moving and get to a fresh question submitted via the comments section over on our YouTube channel. Peter Pavlodecki says, question on TKO earnings recently came out with a profit for the first time, as well as dividend. However, if I'm not mistaken, the dividend payout is more than the reported earnings per share. Why would a company do this? Well, remember, a earnings per share is an accounting metric. Okay, it's an accounting metric. But dividends are paid out with cash flow. So that's number one. So maybe cash flow looks a lot better than earnings. And earnings are expected to rise. While they were only 2 cents last year, earnings are expected to be $2.82 this year, $5.14 next year. Now, what does TKO do? This is the UFC and WWE combined. So that's TKO Group Holdings, the business of professional wrestling as well as UFC. It's doing well. It's headed in the right direction, and it's probably very predicated on ad revenue and pay-per-view. And so clearly the market is seeing, or analysts are seeing, hey, there's probably ad revenue deals that are coming through this year and next year, maybe big fights that are likely happening, etc. And so that's what you're seeing is, yeah, they're paying a dividend because they're expecting earnings to go up, cash flows to go up. And that wouldn't shock me. Right? Both tend to be growing in popularity. I'm not sure about wrestling, but I know UFC is. And their cash flow last quarter, or trailing 12 months, is $508 million. On a $11 billion market cap, it's about a 5% free cash flow yield. And if earnings continue to go up, I'm sure those cash flows will go up as well. So that's how they pay it. It's not with earnings, it's with cash flow. And so that's why when we look at the dividend payout ratio, we don't just look at that. We look at the cash dividend payout ratio, which means how much cash flow is the business creating to pay out that dividend. And based on that, the cash dividend payout ratio right now is 13%. Plenty of room for them to pay that dividend, which looks to be about 1%. So it's not a big dividend yield currently. Let's go talk to Blake in Seattle looking at GAMB, which is gambling.com group. Do you own it or looking to buy it?
Hi, Justin. Yeah, looking to buy it.
Okay. What do you like about it?
Yeah, so from a PE perspective, it looks like it's in around 15, and the forward PE is looking even better. And from what I see, it's a UK-based company, and so non-US exposure right now seemed like another good idea. So I'm looking to get your thoughts.
Well, I generally like your foreign exposure idea, but I'm assuming, do you know if the majority of their customers are US based?
I don't.
Okay. I would definitely look at that. Now, one issue is, yeah, they have good earnings, but their free cash flow is now turned basically flat, over the last 12 months, and it peaked out at about 15 million in 2023. This is a small company, $425 million market cap. Now, very little debt, so I like their balance sheet. Return on equity is 24%. I like that. That's good profitability. However, I don't like that cash flow situation, and I worry that if most of their customers are US based, that's what I would try to find out. The gambling industry in this country is growing, and I would worry that other bigger names like an MGM are going to usurp a company that is offshore, right? This is a Channel Islands based company, okay, and so I would imagine that's why it's trying to get around the gambling laws nationally. And I could easily see a trend change from governments throughout the country on the federal level. So that would be my biggest worry, in the fact that its profitability has come down and its cash flow has come down. Now, from a technical perspective, it's at support, right around support here between, call it $11 and $12. Now it's at $12.06. So it's into that support zone. But to me, it would be a trade only. The MACD is now turned into negative territory. So I would imagine, I don't think this bounce is probably going to last. So it would be a trade only. I wouldn't be buying it for an extended period of time. Thanks for the call.
Thank you very much.
No problem. Now, Leslie, let's talk about saving for retirement. And, at the top of a lot of shows, I talk about mindset. And, mindset is important when it comes to investing, to avoid, as I said, the peaks and valleys of the emotions. But it's also important when it comes to saving. Most people put saving for retirement off too long. And the main reason is because it's hard to really imagine what it is, what it looks like. But studies show that when you do that, when you start with that end goal in mind, you are much more likely to be successful. Now, one experiment, this is a Swedish fintech company, and they had people think about the future first when they're making an investment decision or making a financial decision. And they were 14% more likely to invest in long-term savings products when they were prompted to think more about the future, as opposed to the present. Most people think about the present. What can I afford to save? What's happening in my life today? What's my income? What are my expenses, etc. But when you pose the question like, think of year 2034. What do you want your life to be like? And what do you wish you did today in 2025, for example? And so it's about keeping that end goal in mind. This is what I do with clients, right? What does your retirement look like from a lifestyle perspective? Are you spending more in retirement, less in retirement, the same? Are you traveling a lot? Are you spending time with kids? Are you playing golf? What are you doing? And once you do that, then it feels more real. When something feels more imminent, feels more like, hey, that's not too far off, you're more likely to make those tougher decisions to make that situation better. So this goes always back to have a plan. People get caught up in the minutia of investing portfolios and things like that. And that's fun, that's interesting. But when it comes to reaching goals, you need to set goals first. And when you do that, you're more likely to be successful. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. Be sure to rate and review on iTunes as well. And our second annual InvestTalk Market Madness competition is underway, and you can enter to play and win $1,000 by showcasing your investment skills. Just visit investtalk.com to join the fun and view additional details. Registration does close Monday, March 17th. And if you need help better understanding your financial situation, your portfolio dynamics, and your risk tolerance level, reach out to us at investtalk.com. Click on the portfolio review button and send me a message, and we'll get you on our calendars. Now, we're taking a few days off, but we'll be posting the best of InvestTalk episodes online, so make sure to check those out. Independent thinking, shared success. This is InvestTalk. Good night.